three massive dominoes are falling right at this exact second, and they're triggering a historic, behind-closed-doors wealth transfer that is completely rewiring global capital. In this explainer, we're going to map out exactly how this aggressive financial rotation is happening, step by step.
The absolute most crucial thing you need to understand right out of the gate is this. What looks like a total bloodbath in digital assets isn't actually money vaporizing into thin air. It's a ruthless rotation. Sure, Bitcoin is facing its worst performance in a decade, sliding all the way down to the 13th largest asset globally. But that money isn't disappearing. It's packing its bags and migrating.
Just look at the raw numbers. Over the last 12 months, we've seen a massive 170% explosion in AI and semiconductor stocks, which sits in direct, brutal contrast to a 40% bleed out in crypto. The assets that were the undisputed darlings of institutional portfolios just a couple of years ago are literally being gutted to feed tomorrow's high-growth tech giants.
So, you gotta ask yourself, why is the so-called smart money suddenly sprinting for the exits? Well, there's actually a massive mechanical defect driving this sell-off, which I'm going to break down for you in just a minute. But to really grasp how this works, we first need to look at our first falling domino, the institutional exit, and trace exactly where that fleeing capital is going.
Look at the big players actively redrawing the global map. Take Temasek, for example, the massive global investment titan. They are actively crossing crypto off their lists and pivoting hard into artificial intelligence, aiming for a massive 15% AI portfolio allocation by 2031. Guys, this isn't some quick day trade. This is the kickoff of a multi-decade capital migration cycle that is literally suffocating digital assets of their institutional lifeblood.
Okay, so here's that mechanical failure I mentioned. We've just watched $3.1 billion bleed out of ETFs this year. Now, remember, exchange-traded funds were originally built to be the ultimate safety net, a one-way pressure valve meant to absorb supply and keep prices up. But when that valve breaks and reverses, it's a disaster. Outflows drag prices down, and that mathematical drop just triggers even more aggressive selling pressure.
And you can see this panic spilling straight onto corporate balance sheets right now. Digital asset treasury companies, or DATs, like Strategy, were built as these clever proxy bets on crypto. But as the market tanked, they were forced to dump hundreds of millions in Bitcoin just to replenish their US dollar reserves and pay out dividends. It's insanely ironic. The very companies built to hoard this stuff are being forced to liquidate it at fire sale prices, pushing their actual market value completely underwater.
All right, so the institutional floor has caved in. That's domino number one. But domino number two is wild. How does a tiny strip of water halfway across the planet manage to shatter global crypto liquidity? Well, Wall Street has a very specific, aggressive trade exploiting this right now, which we'll get to. But let's map out the geographic shockwave first.
We're talking about macro geopolitics, specifically the massive disruption in the Strait of Hormuz due to recent conflicts involving the US and Iran. Now, regardless of the politics here, the raw economic reality is that this is one of the most critical shipping channels on Earth. The battle over who controls this bottleneck has sent an absolute shockwave straight through global supply chains.
And trust me, Wall Street did not miss a beat here. In classic Wall Street fashion, they instantly cooked up a massive new strategy they're calling the nacho trade, which stands for not a chance Hormuz opens. To protect themselves against the very real threat of supply chain paralysis, major capital allocators are fleeing risk-on assets entirely. And in the traditional banking world, crypto is pretty much the definition of a high-risk asset.
The immediate fallout from this, a fast 10% spike in oil futures. Now mix that expensive energy shock with rumors that Kevin Warsh, the new Fed chair, is going to aggressively slash the Fed's balance sheet. When you combine higher oil prices with a shrinking balance sheet, it acts like a giant vacuum cleaner, completely sucking up all the excess systemic liquidity that speculative markets desperately need to survive.
So the institutions are out, and the macro liquidity is totally dry, which brings us to the third and final domino. Are the US and the UK locked in a quiet, behind-the-scenes war over your digital wallet? This silent regulatory showdown is permanently freezing market momentum, and to see why, we've got to look at how these two superpowers are clashing. It's a totally fractured landscape right now. On one hand, you have the US taking this rigid, enforcement-first approach, hyper-focused on labeling tokens as securities. On the flip side, the UK's Financial Conduct Authority is playing a totally different game. They're leaning into a flexible, innovation-led model to pull in fresh fintech talent. This massive split between two global financial heavyweights creates total operational paralysis for anyone trying to build or invest in this space.
Now, sure, the U.S. Congress is currently trying to push things like the Clarity Act and the Genius Act to establish some foundational ground rules, kind of like they did for telecoms back in 1996. But here's the harsh reality on the ground. Money doesn't wait around for politicians to vote. Capital is already actively migrating. Billions of dollars are fleeing these murky legal zones and dropping anchor in the safest, clearest global harbors they can find.
So looking at these three massive fallen dominoes, we have to ask the ultimate question. Is this just another temporary crypto winter that we can wait out, or are we staring down a permanent deep freeze? To figure that out, we actually need to rewind the clock and look at the DNA of past market crashes.
If you trace the historical timeline of crypto bubbles, 2011, 2013, 2018, 2022, there is a very specific pattern. Take 2018. The market lost 80% of its value, but the ecosystem still bounced back. Why? Because the retail investors, the everyday people, they always returned. At the time, there was literally no other high-growth asset class on the planet offering that kind of extreme speculative upside.
But man, look at the psychology of today's market. It is a completely different beast. The Fear and Greed Index is stuck at a brutal 27 out of 100. That is pure systemic fear. Between the macro chaos, the crashing ETF flows, and those forced corporate liquidations we mapped out earlier, the mood is just pitch black. The buyers are, quite frankly, completely exhausted.
And this is the structural shift that makes the 2026 crash totally unprecedented. An industry analyst recently said, people want to go where the heat is, and they hit the nail right on the head. That wild, manic retail energy that historically swooped in to save crypto, it packed up and found a new home. Speculative money has aggressively pivoted towards zero-day options on AI infrastructure and aerospace giants like SpaceX. Crypto has literally been starved of its only historical recovery engine.
So we are officially staring down a true perfect storm. The institutional pivot into AI, the massive macro liquidity shock triggered by the Strait of Hormuz, and this chaotic, fragmented global regulatory war. You put those three forces together, and they have simultaneously kicked the mechanical, geopolitical, and psychological pillars right out from under the digital asset market.
The entire board has been wiped clean. The fundamental laws of global capital flow have changed entirely. So as we wrap up this explainer, I want to leave you with one very stark, serious question to think about. As this historic wealth transfer kicks into high gear in the middle of this AI versus crypto war, where exactly is your portfolio allocated?